Hi everyone, I'm Business Development Director at Aire. I've been at Aire 6 months now. Background is credit reference agencies, but I was really impressed about what Aire's all about. So we're helping UK, US problem with financial exclusion, basically. Big problem, and that's why we exist. Our mission is to help the consumer get a fairer access to credit, whilst helping lenders increase their acceptance rate with no risk of increase in arrears, basically. We're leveraging artificial intelligence and machine learning to create the next generation of credit risk and affordability scores. Our company was formed by a guy called Anish Verma, who moved from the US with JP Morgan to London, and he had a real nightmare. So I don't know if anyone in the audience has moved from another country to the UK and tried to get financial products, but it's not particularly easy. And Anish was, well, he still is, but he's an affluent guy, so he had a real nightmare trying to get things that really he should be eligible for. But the problem's much bigger than Anish. In the UK alone, there's 5.8 million consumers that are classed as financially invisible. And there's a number of reasons why they're financially invisible. It could be young people who have just left university, have got a really good job, and they've got really limited credit history. Maybe their mobile phone contract was in their parents' names, because a lot of family mobile phone contracts these days, they didn't have a credit card, or again, it was in their parents' names. Maybe it's older people now who have paid down their mortgage 10 years ago, and because, credit reference agencies, previous history is only 6 years, they just don't have any credit history, and they want to take advantage of, in the world we live in now with low interest rates and 0% APR type deals. But they're just unable to, because not necessarily unable to. It's probably fraught with friction, the process they have to go through for manual underwriting, etc. And there's a number of other examples, such as a couple who could have been married and divorced, and all the financial products were in one person's name. Both of them had jobs. I could go on and on about the examples that exist, but nearly 6 million consumers financially invisible. But the one interesting stat on the screen, for lenders especially, is the 2.5 million marginal declines that happened last year. Now, this is a stat from Experian. And from the 2.5 million marginal declines that lenders made, only 12% of those actually went on to default. So 88% were good customers, good risks, that if lenders were able to make a better assessment, they would be able to find those customers. So some of the problems kind of over and above I've just mentioned in terms of what lenders have. If you think about FCA's increasing scrutiny around affordability and the pressure they're putting on lenders now to get lenders to make better decisions and do more decisions and assessments on affordability, that's causing lenders to have more manual refers, more manual underwriting, and where they don't have manual underwriting, starting to make more declines. So there's a real issue there. It's already touched on the reaching the currently invisible segments, as I've already mentioned, the invisibles, reducing those marginal declines where there is no manual underwriting, and throughout the life cycle as well of a consumer, trying to deliver operational efficiencies. They don't want to increase their spend on manual underwriting, and especially within the collection space too, where a lot of the things that we can do really benefit lenders at the collections. It's an extremely expensive part of the life cycle. I'll touch a little bit more on that as we go through. So we've developed a new solution called Aire Credit Insights. And Aire Credit Insights is very different to what the credit bureaus do now. And we are actually a credit bureau. We're authorized and regulated by the FCA as the 4th credit bureau in the UK. We rely heavily on what we call first-party data. We have an interaction with the consumer at the point in the life cycle where the lender's unable to make a decision or wants more information. And we interact with the consumer by means of what we call an interactive virtual interview, which I'll show you in a bit. Very much akin to a manual underwriter and making that decision. It's forward-looking data. It's not historical. And it can be used across that customer life cycle. It can be used in acquisition for the assessment of affordability and credit risk. It can be used within customer management to try and make a better assessment of credit limit increases, or whether a portfolio has persistency in it and how to deal with the people that have persistency, financial difficulty, all the way through to collections. When someone's missed a payment, trying to understand the difference between a forgetful missed payment and someone's genuinely in financial distress. So I'll touch on the difference between what we offer and the credit reference agencies, because we're not the same as Equifax, Experian, and TransUnion. And we very much complement their data. Experian are a partner of ours and also an investor in our company. And where they do things badly, we do things well. So not that they do it on purpose, but the way they rely on performance data and the 6 years of credit history that you all have as individuals, that causes problems, because if you don't have that credit history, that's when it all starts to fall apart. So that's where we come in, and that's where we help. Kind of similarly to open banking as well, where open banking is very reliant on 90 days or 2 years historical data that's albeit a little bit ambiguous as well. We step in at the stage where the lender is really very much unsure, and that's where we will interact with the consumer. So the IVI, and you can see some examples on the screen, that's our interactive virtual interview. This is the means of us getting the data from the consumer. We ask the consumer lots of questions pertaining to their financial lifestyle, stability, resiliency, some behavioral questions as well. We ask about their profession. And this process is very much dynamic. There's up to nearly 1 million different ways you can go through the process. So if the answer, the first question might be about, do you rent or do you have a mortgage? We'll then ask the next relevant question. So if they ask them, I have a mortgage, what is your mortgage? What is your mortgage payment? Do you have a credit card? Things like that. And it changes as depending how they answer it. What we do within this as well is we're looking at behavioral analysis of how they're answering some of these questions. So if an individual, let's say, is a teacher, and they say they're on a salary of £150,000, we know there's probably a discrepancy there. The behavioral bit is really important to us, and let's say if I asked you what your job title is and what your salary is, you should be able to tell me instantly. So we'll know you will answer those questions very quickly. When you get to some of the questions about income and expenditure, if you just put in 50, 50, 50, 50, 50 really fast, one, we know you're not really paying attention to the process, or you really don't care, and the confidence level about the data that we put in there will start to reduce. But it's not a kind of single factor analysis just on that. We're also using context data in the background to try and validate some of those inputs. So we're looking at that, as I've already mentioned, that job title versus salary. We know the kind of average bill payments, things like that. And we've also had over $12 billion now go through the model that we're then using to validate and drive those decisions. And out the back end of what we do, we provide back to the lender a score based on whatever their problem is. So we could provide back validated disposable income to give them an idea of what the disposable income is for that individual. We can provide back a new credit score, and we can do a lot more in and around affordability to help lenders make those better decisions where the credit bureau data really isn't working. And I think of this really much akin to a bank manager, where 40 years ago the bank manager would understand who you are as a person. They'd understand a lot of different things about you and be able to make a decision. And it is very much like that, what an underwriting team would do right now. I'm kind of watching the time, and I'm slowly running out, and I know everyone wants to drink. So a few case studies. So M. Brown, retail finance company, or point-of-sale finance, revolving credit. Their problem was very much with traditional credit bureau data. They didn't really have a good way to assess those marginal cases that I've already mentioned. And when they introduced a particular bureau's affordability solution, they had a massive increase in declines off the back of that data. So they use credit insights now, both for affordability and for credit risk. For credit risk, during our proof of concept with those guys, we did something like 22,000 interactive virtual interviews with consumers. We had an 82% completion rate of those interactive virtual interviews, which is really high when you compare it to open banking. And the net result for M. Brown was a 9.3% increase in accept rate, with no risk of arrears or increase in arrears rates, which is absolutely what we're trying to do. And that was proved out over a 2-year outcome period. Also, their affordability accept rate went up by 25%. So where they were declining 100 off the back of the bureau data, 25% increase there. And I've already mentioned the increase. And finally, Toyota. So Toyota uses very much at the end of the customer life cycle. Outcomes for those guys is called collections. The other way around, sorry, they call it collections outcomes. And when they've started to lose contact and engagement with their customer in late stage arrears, so this is when a consumer's got to the end of they've handed back the vehicle, and 6 months down the line, the TFS just can't contact, they can't get a hold of the customer. We send out an SMS or email to the individual to ask them some questions pertaining to their financial, their position, and we've helped them increase their resolution time by 25%. So if you think about the operational efficiencies we're helping, first of all, there, where they've got a lot of people making dialer activity, we've greatly reduced the amount they need to do there. We're also passing back some fantastic data on the disposable income to help them understand, do they set up a plan, do they sell to DCA, and also drive a much better customer engagement with that individual to have a better conversation. And that's it for me. I went a little bit over, but if anyone's got any questions, we'll be outside. Feel free to come and find us.
Thank you very much, Andy. That was great. I actually learned a lot about that. I love the distinction between the thin file and the, the marginal.
Yeah.
That's a really interesting space, isn't it?
Yeah, absolutely. When the company first started, the thought was all around thin file, based on Anisha's experience as well. But when we started speaking to lenders, it was very clear, especially the ones that automate their underwriting and don't necessarily have a manual underwriting team, that the marginals is actually the biggest area of opportunity for us.
I do see a lot of parallels between this area and things that are happening in InsurTech. It's just those nuances that are being built in to the way that customers engage. I find it really interesting. So,
and there's the empowerment for the customer as well, isn't there? So
there's an incentive to engage in things that we don't naturally want to engage with, because there's going to be a good outcome, hopefully.
Yeah, absolutely.
So thank you very much.
Thank you.
Thanks,
Cheers.
Andy.